Good morning. I'm your chairman, Graham Kitchen, and it is my responsibility to chair the meeting of shareholders. I'm pleased to see a good number of you shareholders here today, and I extend my warmest welcome to you. Joining us as ever are the King's Fund, a historical charitable organisation specialising in healthcare, established by Queen Victoria shortly after your company was first launched in 1889. It is also a pleasure to welcome shareholders who are joining us through a live stream today. Before we continue, I should mention the usual housekeeping and health and safety points. In the event of emergency, the fire alarm will be a siren. Fire exits are clearly marked by green arrows. This is the point where I always look around the meeting to see the green arrows. The assembly point is on the pavement on Chandos Street, directly off Cavendish Square. Could you please ensure all mobile devices are silenced so that we can proceed without interruption? And please, no photography, video, or other forms of media. It is now 11 o'clock, and as a quorum is present, I hereby declare the 136th Annual General Meeting of AVI Global Trust opened. Alongside myself today, I would like to introduce my fellow directors: June Jessup, Neil Galloway, Callum Thompson, who is chair of the Audit Committee, and Anu Balfour, who you will note from the annual report, Anu will take over from Callum as a Senior Independent Director with effect from today. Also present are representatives of company's investment manager, AVI, the company's broker, Panmure Liberum, the registrar, Equinity, and the corporate secretary, MUFG Corporate Governance. Joe will shortly give you a detailed update on recent performance, activity, and changes to the portfolio. You will then have the opportunity to put all your specific questions relevant to the meeting to the manager and the board. We will then deal with the formal business of putting the resolutions to the meeting. I'm very glad to say that a large majority of the proxy votes are in favour of all resolutions. We have received, however, over 20% of votes against the re-election of June, the chair of the Nominations Committee. As required, we will be engaging with those handful of shareholders who have voted against this resolution, and we will report and update you in due course. To accurately reflect the opinions of all our shareholders and the most efficient transaction of the business at this meeting, I request that all resolutions will be voted on through a poll. In accordance with Article 59 of the company's Articles of Association, after we've heard from our fund manager and answered any questions that you may have. Once the formal business has been completed, please do join us for some refreshments where you have the opportunity to talk to us all individually and raise any informal questions. But for now, please remain seated until the end of the meeting. I'm sure you're all keen to hear AVI's presentations and their perspectives on the company's financial year, and perhaps with some insights on what lies ahead. Good luck with that, Joe. I will now hand over to Joe for his presentation.
Thank you, Chairman. Good morning to all of you, and thank you all for being here this morning in person and online. As the Chairman has said, I'll run through a brief overview of the past 12 months and probably of more interest, talk to you about some changes in the portfolio, how the portfolio is positioned today, and where we see the most interesting opportunities. Looking at stock market performance around the world over the past 12 months, it's been another strong year. The strong performance across the board masks quite a lot of volatility, particularly around April time as the US tariffs came into place. But what is interesting, I think, about this past year, and this differs somewhat from previous years, is that whilst the US and particularly US technology companies have once again been very strong performers, what's notable is that The US has not been the only game in town over the past 12 months. There are other markets that have begun to perform equally strongly, if not stronger, and there are signs that there is life outside of the US. Notable examples of this that are relevant to how we are invested and where we are finding opportunities is Japan, both large cap and small cap, and particularly the KOSPI index, the South Korean index, but also very strong performances from Europe and emerging markets as well. And this is important. I think it highlights that investors have become more discerning, recognizing that the US is not necessarily the cheapest market or the most attractively valued market. Yes, there is the AI theme, and that's exciting for some investors. But the fact that capital is flowing into more interesting parts of the market, I think is very, very important and very relevant to us. There has obviously been a lot of talk about whether US technology companies are in a bubble. Timing a bubble is notoriously difficult, and determining whether we are in fact in a bubble is really impossible. So our approach has always, as you know, been to focus on valuations, to make sure we're buying good quality businesses that we believe are growing in value and that have a catalyst for unlocking that value over a reasonable holding period. And we believe that will deliver strong returns for us and our shareholders over time. Turning to our own performance, I think when we look back at the year, a performance of 12.4% is respectable, both in absolute terms and relative to our long-run average annualized returns. It is a bit behind the world index and the world ex-US index, but I think more relevant when you look at our rolling 5-year period of performance, still ahead, as you see previously and on this slide, still ahead of the broader indices. Again, in thinking about the performance of the portfolio over the past 12 months, what we show here is every stock within the portfolio, how it has performed. What's notable is that around about a third of the portfolio, 36% of the portfolio names actually beat the MSCI World Index, so strong performance from there. A large number generated positive returns, but not as much as the World Index. And on the negative side, we were weighed down by one particular name, and that is Gerresheimer, the German conglomerate that detracted a lot. Absent that, of course, our performance would have been much more in line with the broader index. Notable contributors, as you see here, from amongst the largest names, the handful of largest names, was D'Ieteren, which generated 2.5%, and ACA, which we have been selling as the discount has largely disappeared, but again, a strong performer. I don't show you the names here, but what is also interesting about the performance of the portfolio is that the largest names had a rather underwhelming year in terms of share price performance. They performed okay, they didn't beat the index. But encouragingly, from our perspective, looking forward to our returns, they all got cheaper. And by that I mean that the NAV side of the equation grew and performed well operationally. The businesses all did fine. But from a stock market perspective, share prices lagged and discounts widened. And that for us provides very attractive prospective returns going forward. I've shown you this previously, and certainly from where we are sitting, where myself and the team are looking out at opportunities across the board, we see the effect really of what's happened in stock markets over the last 10 years. By that I mean everybody's interest has been focused on the US, on an ever narrowing group of companies within the US stock market, and that has meant that most investors are ignoring large swathes of the stock market. As I said earlier, there are signs that that's changing, and certainly with the tailwinds of capital flowing into other parts of the stock market, that's encouraging. But it's really fascinating to see how our portfolio is trading at a 40% weighted average discount. This is the kind of discount we tend to see when markets are panicking and really falling sharply. It's not the kind of discounts we tend to see when markets are relatively benign, if not optimistic. And we see across the board, wherever we look at the areas of focus, we see very wide discounts in absolute terms, and in some cases, discounts that are widening, that are certainly at the wider end of the average. So this really, in terms of looking forward for prospective returns, for finding attractive opportunities, is highly compelling. And I'm convinced that the markets won't, or investors won't, ignore these opportunities indefinitely. Turning now to the portfolio and how that's changed over the past 12 months, there are a couple of features to highlight here. The first is Korean holding companies, which you see we've initiated an allocation to with a 12% weight currently. That's spread across 10 different companies. Previously, we had no exposure to Korean companies, and I'll talk a lot about that in a few moments. We also increased our exposure to general Asian holding companies. Again, I'll come back to that in a few moments. And to fund those increased allocations in those areas, there was some profit-taking and reductions in different areas of the portfolio, but primarily the broad exposure remains the same apart from those new areas. Okay, so I want to spend a few minutes talking about South Korea. It's been a big shift in the portfolio, and it highlights also one of the differences in our approach and our approach at AVI Global compared with other global investors. And that is, we're prepared to back our conviction when we find interesting opportunities, when we find attractive valuations and compelling catalysts to really go for it and not worry about what the benchmark allocation is. So our 12% weight in Korea compares to a benchmark weight of 1%, and it's fair to say that South Korea is off the radar for most global international investors. So why is it interesting to us? It's a market that we've been looking at for a number of years. It's a market that is undoubtedly cheap. In fact, Korea has suffered from what has become known as the perennial Korea discount. When you look at holding company discounts in Korea, it's not uncommon to find discounts 50, 60, 70%. The reason the market has been so out of favor has been the perception that the market is controlled by a handful of very wealthy families who control the largest, most valuable companies there. And they run these companies in the interest of their families to the detriment of minority shareholders. So why have we decided to go for it now? Well, there's been a change in the politics there. There's been a new president appointed earlier this year, and he has come into power on a platform to boost the stock market. So he came in on a Kospi 5,000 platform to take the index up to 5,000 from around 2,700 when he came into power. And he's trying to broaden out the ownership of the stock market by removing some of the hurdles and stumbling blocks that have put off minority investors, and through a mix of a stick and carrot approach to regulation. So companies are being compelled, for example, to cancel treasury shares. The votes of large shareholders are being capped at 3% for certain agenda items. And there are a host of carrot incentives, such as taxation on dividends, designed to encourage companies to be more shareholder friendly. So when we look at the opportunity set, not only do we see very wide discounts, but we also see a very clear, compelling catalyst as to why those discounts should narrow. And the evidence of the past 6 months has been very encouraging, if not reassuring. Discounts have started to narrow. They're still very wide. And investor interest has started to shift, and we are seeing, interestingly, a lot of investors who we've come across in Japan, where there are a lot of overlaps with what we're seeing in terms of corporate governance reform in Korea, invested alongside us in some of these names. So I'll give you one example of a Korean holding company. Much of what I'm about to say describing this company could be said about the other 8 or 9 companies that we have in our portfolio in Korea. HD Hyundai is family controlled. It's trading at about a 52% discount to its NAV. Its NAV is made up of 3 listed companies, making up a lot more than their current market cap. So it's trading very cheaply. The two largest listed assets are HD Korea Shipbuilding and HD Hyundai Electric. Both those companies have very, very powerful tailwinds in terms of operating performance and future growth in profitability. The shipbuilding business is the world leader in energy efficient, environmentally friendly LNG manufacture building. And it's also a leader in naval vessel shipbuilding, and it's won huge contracts from the U.S. Navy to build vessels in the U.S. for the U.S. Navy. So on that front, there's very powerful, there's very, very strong visibility on earnings, very strong order backlogs. And so not only do we see a wide discount, but we also see strong earnings growth. So both sides of the equation should be working for us. HD Hyundai Electric is involved in power and transformers for power grids. Again, we've all been reading about the need for more energy for the data centers that are powering the whole AI theme, and there's a lack of capacity. So HD Hyundai Electric is a big beneficiary of that. As you see here on the graph, since we've started investing early in the spring, the discount has come in from almost 70% to 50%. It's generated a pretty strong return on investment of almost 40%. And as I said, the same really can be said for most of the companies that we have in Korea. And we also have a mix of companies. This company is quite large. We've got some quite small companies, some quite mid-cap companies, and some very large companies. I showed you earlier that the increase to Asian holding companies up to about 4.5–5%. All of that is in Jardine Matheson, an old favorite of the company, which we've been out of for a number of years. We reinvested into it earlier this year, and the reasons really were that really twofold. We were seeing signs of life at some of the underlying companies when not much has happened in recent years. And on the discount side, there have been some changes in the family. The younger generation have taken over from the older generation, but also there have been some management changes and some strategic changes that really highlight the fact that the company is going to be more proactive in managing its portfolio, more conscious of its discount and its valuation. And this has already seen a narrowing of the discount. So again, it's been a good performer for us, both on the NAV side and on the discount side, and we think that there's certainly more to come. Early indications of how the family are being more proactive are a recent takeover bid to take Mandarin Oriental private. They already owned about 90% of it, so they're buying out the rest of it. There's a strategic review going on at Jardine Cycle and Carriage. There are signs of life in the Hong Kong office market at Hong Kong Land. But all of that points to more powerful tailwinds, both on the NAV side and on the discount side. And I'll end with one example from the portfolio. Again, this is a name we've spoken about in the past and has been in the portfolio for many, many years to a greater or lesser extent. But again, it highlights how investors are so disinterested in many of our companies, how discounts can widen out to really abnormal levels, anomalously wide levels. So the discount on Exor today is pushing 60%, 57, 58%. We've never seen that before. Exor continues to have a fabulous long-term track record of delivering superior returns, well above benchmarks over many, many years. There's a powerful alignment of interest between the controlling family and minority shareholders. The portfolio is very transparent. There's very little in the way of unlisted assets to cause debate about what the NAV is worth. And there's also, whilst no certainty on what the company will do, there are signs that with a meaningful inflow of capital coming into the portfolio in the next few months, and looking at what the company has done in the past, there is the prospect of quite a large share buyback, I would say, which on these very, very wide discounts is very accretive to ongoing shareholders, but also sends a very powerful signal that the company cares about the discount and it won't be allowed to widen out indefinitely. So, these are some of the things that we've been doing in the portfolio, adding to, and these are some of the reasons why we find these compelling opportunities. But it's fair to say, as I said earlier, that across the board, we feel very comfortable with the portfolio. We see very, very compelling operational and underlying indicators of performance, and off the discounts that we're at today, we think that should provide a powerful tailwind to our performance. And that really is what I wanted to end off with. The discount is, as I say, very wide. We're positioned at the moment where in a situation where we're not utilizing fully the gearing that is available to us. So we have been reducing the gearing in recent months. We're 1 or 2% geared, which means we've got over £100 million of dry powder to put to use gradually in some of the newer names, but also potentially if there is some kind of volatility at any point in time. That's not to say we're calling for a correction, but a more volatile environment does throw up opportunities. And certainly, as we've seen within our portfolio, it's not always a straight line, and the market does offer us opportunities to take advantage of inefficiencies. But I think I would say that the ingredients are all there for attractive long-term returns. And as I've said before, we're sticking to our knitting. We're doing what we think we do best, and there are a huge number of opportunities for us to capitalize on. So thank you for your support, and if there are any questions, we'd be happy to take them.